the Governmental Affairs Conference 2026, joined by Bob Child today. Welcome.
Thank you for having me.
Absolutely. Bob is with Origence.
Correct.
And we're going to talk auto lending. But if you want to do a quick little intro of yourself and the company, please.
We are the largest auto lending platform for credit unions in the U.S.
And so with that, obviously, auto lending has been kind of down lately, a little slow. And that's credit union's bread and butter. So.
Correct.
Talk to us a little about where you see it going.
Yeah. So let me just take a step back and reflect on 2025. So 2025, Origence processed $62 billion worth of auto loans on behalf of credit unions. That was a 17% increase compared to 2024. So credit unions got a little bit more back into the game in 2025. Now, you were 100% correct when you said auto lending was down in 2026. January positively was down. Now, with that said, there was a little bit of cold weather and snow between the Midwest and the East Coast.
We got it in South Carolina. So
South Carolina in the month of January. So we started to see it come back in February. So February was picking up. And I think there's going to be a bunch of pent-up demand, which comes in March. Now, the other thing that's going to happen starting March and April is apparently I'm hearing rumors that tax refunds are going to be higher this year than in years past. Again, I'm not sure who's getting those because clearly I'm not getting one of those. But apparently there's a lot of people who will be getting a larger tax refund. We think that that will spur increased auto lending for the months of March and April. Then we're going to see that lull again. So now the projections come in. Now we look at it and go, okay, so what does the rest of the year look to shape up like? All of the analysts that we're hearing are predicting 2 rate cuts in 2026. If that happens, that will spur another round in the second half of 2026 for auto lending. Now, with that said also, new car sales. New car sales, I still think, will be down about 3%, 3 to 5% in 2026. A bunch of challenges there. One is car prices are going up. The average car price is now over $50,000.
That's insane, yes.
The average monthly payment on a new car is now close to $750. I mean, that used to be a mortgage payment.
Right.
So it's crazy to think about that it's out there. So from an affordability perspective, and we think about all this news about the K-shaped economy and everything, I think that new car sales are going to struggle. And when that starts to struggle, what happens is the manufacturers turn to their captive finance companies. And they're going to say to the captive finance companies, we need that 0% financing or that 2.99% financing. And once that starts to happen, it's really hard for a credit union to compete against 0% or 2.99. So put aside the new car opportunity, then you look over to the certified pre-owned and the used cars. Here's a great one. Just on EVs alone, whether or not you like EVs or not, there's going to be 300,000 EVs that are going to come off lease in 2026, and they're going to be at low cost prices because of the depreciation that EVs see. There will be a strong resurgence of interest in these used EVs because of the price that's out there. And I think it's a great opportunity for credit unions that are there. In addition, people that are saying that the new cars are too expensive, we'll look to the 1 to 3-year-old cars
Right.
in the used side. And again, this is the sweet spot for credit unions
Yes,
that are out
for
there.
sure, for sure.
So,
You were mentioning, used EVs. The battery's life is pretty limited at this point. So, as you mentioned, they're going to be depreciated. Um, do you think that's still, though, going to be a market for cranes? Because generally used cars are credit unions.
absolutely,
Yeah.
I definitely do.
Mm-hmm.
I definitely see that as a market opportunity that's out there.
Yeah, yeah. And again, you talked about affordability.
Affordability is a challenge.
At some point, something has to happen, or either cranes won't be able to lend because the loan to value, or not the loan to value, excuse me, debt to income is going to be out of this world. I mean, I don't buy new cars anymore because of that.
Absolutely.
Got a few years old Mercedes, but like.
Well, I remember when a 5-year loan was unheard of. Now
It's 8, 9.
8, 9.
Yeah.
And so I think we're going to start to see the loan length go even longer in order to support a monthly payment, which is interesting.
I was going to say, there must be
Yeah.
risk involved with that.
There definitely is risk because you run into negative equity.
Mm-hmm.
That is a big problem in our industry right now, is the amount of people that are rolling last car's payment into this car.
Mm-hmm.
And so that creates a lot of challenges out there.
Mm-hmm.
The other challenge, which we're talking to credit unions about, is auto insurance. So auto insurance rates have spiked 77% over
I
the
remember
last.
that this year, yes.
Yes. And so, I mean, it's gotten to the point that, you mentioned debt to equity ratios and things of that nature, that as a lender, you almost have to start to take that into account. What will your new car insurance payment be on top of your monthly car payment? And almost think of them together because
Get rolled in like a mortgage. Yeah.
a mortgage.
Yeah.
So it's a scary thing that's happening. At some point, they're going to have to regulate this insurance market better.
Mm-hmm.
So
For sure, yeah. Federal charter. Who knows?
Well, I think a big chunk of it is, well, now you've got increased parts prices because of tariffs.
Mm-hmm.
So that factors into the insurance. And then you've got all of these plaintiff attorneys that are suing for dollars, which is driving it up too.
Yeah,
So
for sure.
it's a challenging market, but it still is a great opportunity with some of the best yields for credit unions that's out there. And right now, the margins are the widest on auto lending that they've been in 5 years. So again, a great spot for credit unions to come back into the game. Liquidity remains a little bit tight in some credit unions, but we're starting to see it free up.
Yeah.
So
Yeah, and shoot, I lost my train of thought.
delinquency. Let's talk delinquency for a second.
I
Delinquency
was gonna
is
get there,
high,
but yeah.
but it's starting to come down. So we saw this little spike in delinquency, but it's starting to tail back into a little bit more normalcy. But we do hear from credit unions about the concern in delinquency. And again, it's that K-shaped economy segment that some of the lower incomes are struggling with the
Inflation,
increased
too.
inflation.
Yeah,
Right.
yeah.
So the price of milk and eggs, and so no matter what Trump said in the State of the Union, it is more expensive for
it is.
consumers out there today. And so disposable income is shrinking more and more.
Our health insurance went up 25%.
Health insurance, another thing. Absolutely. It's
yeah.
just squeezing that disposable income.
For sure, yeah. And the other thing I was going to ask about too is the non-interest opportunities around it as well. Credit unions, I think, they are so interest rate sensitive, and which is they're in the business making loans. They should be.
Correct.
But also, there's all these packages around them that we need to get better maybe at selling for the
Yeah.
non-interest income. There's a great opportunity there too, I think. I don't know what your thoughts are.
Oh, I totally agree.
Yeah.
I totally agree. I think that there is that opportunity for aftermarket products and other add-on solutions that can provide income for credit unions.
Yeah, for sure. The undersprays even.
Yeah, absolutely.
Yeah. And so I think we've seen interest rates on used cars. Are they doing any better than new?
Yes, they're coming down.
Yeah. I thought so, yeah.
So, and this is the thing that I also remind credit unions is that the big banks, when interest rates are declining, the big banks will reduce their rates ahead of a Fed reduction. So if they have confidence that a Fed is going to make a rate reduction in the upcoming quarter, they will start to reduce their pricing on interest rates early, recognizing it's going to be a 5-year or 7-year loan. So they tend to get more market share early
By
on
grabbing
that.
that, yeah.
Versus credit unions will wait until the Fed reduces the interest rate before they will reduce their interest rate. So credit unions tend to lose market share if they don't
That's a great point.
build that into the pricing. Conversely, as we saw in 2021, when interest rates were going up, the big banks slowed their lending, started increasing rates, and the credit unions were slow to increase rates, and we got a flood of business.
Yes.
Probably didn't want all that business, but we got a flood of business. So,
People need cars, and you sure as
People
heck
need
it's
cars. You
hard
just
to
gotta-
buy one for cash anymore.
right, just got to price it appropriately.
Yeah. And so what would you like to leave our credit union audience with today?
That, we at Origence are very bullish on 2026, and particularly around used cars. We do say price and underwrite smartly, be careful of the economics that are out there, and also think about the insurance component as part of your underwriting metrics
Yep.
as a new
Awesome.
thing going forward.
That is so interesting. Thank you so
Yeah.
much for your time.
Thank
Appreciate it.
you. Appreciate it.